Have you been trying to find that one model to trade for the rest of your life? A model so mechanical, there's no guessing. I'm about to reveal my one model for life, the Singularity. Today I'm going to talk to you guys about my one model for life, which I've called the Singularity. It's called the Singularity because it takes a few of the really core pieces of what ICT teaches and combines them all into one very simple, very mechanical trade setup. And I want to start with a little bit of history on it. It's been in development for a while, which might sound funny because it's actually that simple, but it took some time to figure that out. So I want to show you that history and give you an idea of what this model is based around. And then, as you can see in the mess of things on the screen, I have a pretty picture to show you what it's about. And then I can show you, I've got about 6 or 7 examples in the charts that I can show you. So what I want to start with is this model started around basically a London sweep. It wasn't even a London sweep. It was more of an overnight liquidity sweep model, which I called the night owl, since it swept the overnight liquidity. I kind of like giving models fun names. So as you can see, I've just pulled up what little evidence I have left of this model early on. So you can see here at April on this image with the big blue square. I don't want to mouse over it because then it changes things. But April 28th, 2023, I said, here's a preview of what I was able to do in January, which was a backtesting session that includes a bunch of conversation here that I'm going to keep hidden. But in January, this model did really, really well. It does seem to do much better certain months than others, but this was the night owl. Started really developing it back in April. So I can get rid of that. What I have here is what the model consisted of. Basically, on a 15-minute chart, this isn't the model I'm trying to teach, so you can just read through this really quickly. Basically, you would mark out the overnight high and low between midnight and 9. Yeah, between midnight and 9 on a higher time frame, just so it's easier to see. And then you'd wait for one of those levels to be swept, look for a reversion, market structure shift, and then a little retrace back to a fair value gap. It was really that simple. And it worked really well, but there were times where it didn't, or months where it didn't. So that I stopped doing that. I don't think I ever did trade this. I did trade this live. But I stopped trading this and we moved on to some other newer, shinier, fancier ICT teachings like the unicorn model, and I tried one shot, one kill for a little while, a bunch of different things. So anyways, it started with that, and then it evolved into, it started with that. I should say that. It started with that, and then I came across an individual who I've talked about here on this channel before and explained his trading model, Nexus Blast. His model is basically an overnight model, the night owl, only he utilizes session liquidity, which can happen at multiple points during the day, whereas I just used the overnight high and low. And that felt a little more significant. Like that's likely maybe something the algo tracks, and the algo will seek to mitigate sessions liquidities instead of just whatever the high or low was from overnight. It just felt more detailed in that respect. So I traded that model for a little while, and it's great. It all takes place on the 5-minute chart. Like I said, I talked about that in a previous video, where I even did an updated video on it, including an indicator that was developed between him and another individual to auto chart all of your session breaks and session highs and lows. Works really, really, really well. So I liked it, and I've been stuck with that sort of concept, but of course I have to make it my own. So once ICT released his One Model for Life video, which basically just laid a foundation for you to build a setup off of, really just the core first steps you need to get started. And I took to that. Really what he did is he went through and marked out and kind of taught all the session times in the whole 24-hour period of a day. These are the session times that you should look for sweeps. That was really the whole video. And then he's like, explaining once that happens, you can use this kind of entry model, this kind of entry model, this kind of, and he just went down a list of like 6 or 7 different ways you can get into a trade based off of those sweeps. So I'm like, sweet, I already kind of have that. So I took Nexus Blast, modified that to include the session times listed here from ICT, which aren't the session times from Nexus. So we can now move on to talking about this pretty picture here, which I'm sure you guys have all figured out since you've been staring at it for 5 minutes. What we have is I trade the New York AM, so this is specifically talking about that. What you see here is some whatever range between 2 a.m. and 5 a.m. This is the London session. And these are the highs and lows that you're going to mark out. So whether that's done with an indicator, whether that's done manual every day, doesn't really matter, but you want to mark out the high and the low of the London session, which is between 2 a.m. and 5 a.m. First step is you're going to wait for a sweep of the previous session high and low. So you're going to wait for a sweep of that high and low, which here we sweep the low. Then price is going to revert and create a market structure shift with displacement. The reason you want displacement to be happening in this price leg is you want a fair value gap. So once price shifts, in this case, this is a bullish example, price will market structure shift and leave behind a fair value gap and an order block. So you want to identify and mark out both of those. You need both of those. If it reverts and just leaves an order block and there's no fair value gap, this trade is invalid. It might still work out. You might hit the order block and be just fine. But for what I look for, I need both. I need an overlapping combo of PD arrays there. Once the market structure shifts, it'll come back to the order block. The fair value gap is kind of there as an extra and reinforcement to the trade. You don't necessarily trade off of it, but the way I like to think about it is the fair value gap is the inefficiency that is looking to be filled. So it's looking to draw price back to the order block where it can get that liquidity. It can get to that level where the big boys are buying again. So the fair value gap acts as the magnet and the order block acts as the launching pad. So you're just drawing price down to that launching pad after it's already indicated the direction that it wants to go because of the market structure shift. And then it takes off. So your target's going to be the opposing session or external liquidity level. You can test on what you think is the best way to go. Some days it'll only come up to this external liquidity. Some days it'll come up to the session high of that's untapped of London. Sometimes it'll go higher and there's an untapped liquidity level from the previous day New York PM, or maybe there's a lunch session high up here. It just has to be some major pool of liquidity, whether it be just overall external liquidity. You don't want any little internal ups and downs to be factored in there. You want a major swing high and a major swing low as your target, or the previous session's high or low, somewhere previous. Those are major levels. So in this case, I drew two, whatever these are called. One targets the London high, which is low hanging fruit. This is pretty much what I target every time. It's just that previous session. But there was also an untapped level way up here. And so I have another one drawn out here. As you can see, we enter off of the order block. We let the fair value gap be the magnet that draws us back to that entry point. Your stop loss will be 2 ticks below the order block. It is very common for an order block to be filled to the tick. Then you have spreads, and then you have which is a tick, and then you have breathing room, so you don't get tapped out from spreads, which is another tick. So you want 2 ticks below the order block. You enter on the order block, and you target whatever liquidity you think is best for your style, your mindset, your risk management. In most cases, I do the opposing London high, as long as it's untapped. Otherwise, I hit the next major external level. So with the pictures out of the way, I'm going to show you some examples. This one was actually from Monday, which, terrible day to trade. Price action was crap. I mean, it's basically a straight line. But right at open, we caught a little bit of something. I actually did take this trade, but I have the habit of moving my stop loss to break even once I feel like I'm on side. And as we can see, it came back down to my entry. So I got stopped out break even here, which is fine. It's not a loss, not a win. It's just, it was just fun at that point. But it did, in fact, go to the target. So I'm working with whether I should be moving my stop loss much at all. Maybe just reduce it a little bit instead of break even. Anyways, so this red line here is the London low, which it came down and swept very nicely, started accumulating, and just bam, took out some more liquidity, large wick. That's a very nice, see if we can zoom in a little better here. Very nice indication right there. It then impulsed up and broke structure. Immediately came right back down to the fair value gap and order block, and then launched off. To see this on a crappy pre-holiday kind of day, it looks really good. I was in it, and as we can see, I do actually believe this is the London high. It was either this that's the London high or this that was the London high, and it had already kind of poked through it. Set your entry on the order block, 2 ticks behind the order block for a stop loss, and target the external liquidity level or the previous session untapped level, and it went right there. It was a long trade. That was entry basically right at 9:40, and it didn't tap out until 12:40. So it's a good 4 or 5 hour, I can't do math, 4 or 5 hour trade. But nonetheless, worked out really nicely there. So here is another example. This was Friday, which was a crazy bullish day. And I'll yeah, I think I can do this and still be able to see. Yeah, here we go. I'll show you why that didn't work out for me to get into the bullish. It doesn't follow the model. It's there. There's multiple ways to get into a trade. This one doesn't catch everything, but here's the London session. We swept London's high, but you can see it just kept going. So kind of once it got to here, I can't trade until 9 anyways, which is way over here. So this happened way early in the morning. We swept this high. I prefer to see the London session swept closer to 9:30. Then I know I'm going to have a setup because it'll react off of that liquidity. If it sweeps right away, sometime far in the middle of the night, I'm probably not going to get the setup I want. Little tidbit there. So it swept London's high and kept on going all the way up until this big wick is 9:30. But since it swept London's high, I'm looking for shorts. That's it. Not a very good day for shorts, but one did appear. We kept trading bullish, and we started coming back down. You can see here we hit something. I don't know what at this point. I could probably go find out if we hit anything to help us turn around, but nonetheless, we market structure shifted. So I marked that out. Marked out my order block, which is these 3 candles right here. And there's a tiny little fair value gap in there in the leg that created the market structure shift. So this should be up here. Sorry. Oh boy. Oh boy. The magnet really messes with you. 1, 2. Drawing upside down. I mixed that up. So anyways, you enter off the order block. As it comes back to it, you're 2 ticks behind the order block, just in case, and you target the next level of external liquidity, which on such a bearish day, I actually do believe I don't believe I took this trade. I tried to take this trade. So you target the next external liquidity on a very bullish day. You're not looking for anything huge. I honestly didn't think this was going to continue to come down, so marked this out as it just needs to get here. Now, had I been more experienced, I would see this as a sweep of liquidity and find an order block, fair value gap, something to take along. Alas, I'm not there yet. That's okay. That's why I have models like this. Next is, I'm just going literally back by the day. I'm not really cherry picking these. I'm just showing you that it happens basically every day. So this is Thursday, just before that. Thursday, price does come down and sweep London's low. We got a bunch of nice wicks showing we've got some rejection on that liquidity. It market structure shifts right away and trades higher. It does leave a fair value gap behind. These 3 candles are your order block. Oh, I was going to explain the order block drawing. So ICT mostly draws order blocks with the bodies of the candles. Sometimes he uses the wicks, and I've never really understood the difference as to why he uses one over the other. So I've decided to go with drawing order blocks off of the bodies of the candles. However, I don't feel comfortable leaving my stop loss right here. I prefer to cover the lows, which is a comment that is made all the time. So I draw my order blocks with the leading edge is the bodies of the candles, and the trailing edge, the stop loss side of it, I cover the wicks. That just helps me visualize my stop loss should be below the lows or above the highs, just to protect myself. Once I'm on sides and I start breaking structure, you can reduce your risk a little bit or whatever you want to do. Anyways, we came down and swept London's low, shifted and displaced away, mark out our order block, mark out our fair value gap, enter on the order block. Stop loss is 2 ticks below. It comes back. I don't think this taps in unless spreads were in your favor somehow. But nonetheless, you get tapped in, you take off, targeting, see here was London's high. So targeting next available external liquidity level. You could take a partial here too, midway through if you wanted. Taps that perfectly. And then you're moving on for the rest of the day. Next example, a lot of these are bullish. It was a very bullish week last week. So London's low is right here, this grayed out line. I didn't draw a nice red line, but draw that across the screen. It sweeps. You get some nice wick rejections, which I always love to see. This one was a little weird for me, so I drew 2 order blocks. still new enough to order blocks where it's hard for me to figure out which one's the actual valid one. But if at a minimum there's 2 in here, and that's even better. So these down close candles, even though this one closed a tick green, 2 ticks green, whatever, these down close candles make an order block. It does displace away, but it doesn't break structure or leave a fair value gap. It just kind of takes this and comes back down. So and then rejects again. It displaces away and market structure shifts, leaves a fair value gap. So I marked this as an order block 2, whether one is more valid than the other. I put them both on there just in case. They both happen to have the same high. And the fair value gap has the same high. It all lined up at the same high. So I was like, it doesn't really make a difference at this point. One of those is valid. So it market structure shifts with displacement. You put your entry here. Quite a big stop loss, 8 3/4 points. So this would be one where I would move to reduce that at some point. Maybe up here. Once I figured out I was on sides, I'd cut it in half-ish, somewhere around there. Anyways, it takes off very nicely. Immediately takes out this liquidity, which is not session, but the next external, really close to that session liquidity. It does come down some, but again, impulses away and takes out a previous session's high. This is New York PM high from the previous day. Takes that out and comes all the way back down. So there you have that. Next example is a nice one. I didn't draw out these London lines very well, I see. So we took out London low, started rejecting and turning around. You can see, large wicks showing that liquidity grab and rejection. We break market structure here with displacement. So I mark out the down close candles from the bodies on the high to the wicks on the low. There's my order block. During the shift, it did leave a fair value gap. Mark that out. And I drew this wrong as well. We want to enter on the order block and target previous liquidity. So as you can see, entering on the order block worked very well. You see how it wanted to go, but it left behind an imbalance. You notice once it takes out this imbalance, which it filled to the tick, there's no other inefficiencies here before it takes off. It fills everything up as far as efficiencies before leaving. So seeing that alone makes a person very confident in this trade. So it comes down, taps our entry on the order block, and takes off. You could have marked London's high, which was untapped. Really nice place to be. You could mark, let's see, this is the high from previous day's lunch. Couple points higher than that. And then the AM high from the previous New York morning session. You could go high. I mean, it went way higher. So it's not like I'm like, oh, this is the highest point, so we're going to mark that and find out why. No, man, it goes way higher than that. This is just a good level. Previous day's high, really. I think it was the highest point of the whole previous day, which previous day's highs are also very key levels to pay attention to. So this could have gone way higher. You could have left a runner and just held it until it started doing this bopping around barcode consolidation. You're like, it's probably not going anywhere now. It's getting close to the end of the day. We'll close it. But this catches almost the entire daily range in this case. This model is very powerful. It's very simple, barely 4 steps. And it catches some good moves. So we'll move on to another bearish example. Here, price takes out London's high and starts turning around from that. You can see, again, it takes liquidity, it starts wicking like crazy, which is a great sign. turns away, market structure shifts, creates an order block and a very tiny fair value gap right in here. But it's still a fair value gap. Price comes back to grab it and takes off. I only went, in this case, to the opposing session level, which is the London low. Took out the London low with no problems. It continued to go a little lower, but that's okay. I don't think there was really anything lower to mess around with anyway. So took that out. Beautiful trade. Okay. So let's move on. I don't think I have any more. Yeah, I do. All right. Another bullish example. So here we took out London's low and we came down pretty far, which it can do. That is fine. Maybe you have a way to get into this. Maybe you don't. I don't. So I wait. It hits the bottom, starts wicking away. You know, it's grabbing liquidity somewhere or it's trying to turn around. Those wicks are really key, indicators as to what price is thinking. Starts turning around and does shift. Market shifts over the last swing high. Leaves a fair value gap. So you notice all the other examples, the fair value gap was either in the bullish order block, touching the order block. It was overlapping in some way. This one wasn't by a couple of ticks, and that's okay. It needs to be near or overlapping. You don't want it to be so far away that it can't act as a magnet to get price to the order block. It'll probably just hit that fair value gap and never go back to the order block. It's too far away. So you want something that's within a point or so of the order block. But we've got those two. Enter off the order block, which this isn't even lined up. I'm not very good at this. But either way, it taps that order block. Zero drawdown, basically zero drawdown. Taps it and goes. And you target external liquidity up here somewhere. This went quite far, almost 30 points. I think that was my last one. Because eventually we're going to get to the beginning of the contract where price gets all gross. Yep, I think that was my last one. Yeah, see now here it's getting all nasty. So very easy, very basic setup. It takes order blocks. It takes fair value gaps. It's very similar to 2022. It's very similar to any other, session sweep style model. It's not, and this may already be in existence, and I've just discovered it myself and named it something. It's not revolutionary. It's not groundbreaking. It's simple. It's the core of ICT's teachings. It's focused around time, inefficiencies, and liquidity. That's what makes the algo go round. So I think this model works really, really great. I've traded it, let's see, I think last week. So not this current holiday week, which is going to be terrible price action, but the previous week. Forgive me, I don't know the dates on it. It was the last week in June. If we go back and look at these examples, we saw somewhere between 80 and 90 points that these trades captured. Now, if you can even capture some of that, you're looking really good for the week. The other nice thing about this strategy is you can apply it to any session. I like New York AM session, so I look for London sweeps. You can trade the New York PM. And at that point, you're looking for a sweep of one of the AM levels or one of the lunch levels. And then your PM setup will take off from there. So you can trade this any session. You're just looking for a sweep of the previous session's high or low. A previous session, not the immediate previous session. Just look for a previous session's higher low sweep. It reverts, market structure shifts, you got displacement leaving a fair value gap, mark out your order block, and put in the limit order. Worst case, it never comes back. Worst case, it blows through and seeks more liquidity. I did not ever mention why those high time frame levels were key. I apologize. Speaking of the blowing through. So what you want to see with those higher time frame inefficiencies I had you mark out at the beginning of the video is if your London sweep comes into one of those, that is much more, I hate to use the word guarantee, but it's much more of an indication that price isn't going to want to go lower. It's tapped into that higher time frame PD array and is moving away from that. It's not going to come back. It's not going to shift, and the shift is a fake out, grabbing more liquidity to then shoot down through your stop loss. If you're already tapping into a higher time frame PD array and your bullish order block, and it all lines up like you've got a nice 1 hour, oof, that's bright, nice 1 hour bullish order block here, and it comes down in, creates the time frame you're in, 3 minute order block, and starts moving away. That's it. That's a wrap. Take the trade. This is much more of a clear indication of confidence when you come into a higher time frame PD array and then start moving away and create your setup. So that's what those are for. Keep those higher time frame PD arrays on your chart and just kind of pay attention to how it reacts to those. You can also use those as targets. If you've got a new week opening gap up here and a session liquidity level right near it, and just kind of different confluences saying this is probably a good place for price that it's going to want to go. Good place for it to go. Let's target that level, maybe bump it back a couple of points. You don't need to call the top. You don't need to call the bottom. Take out a chunk in the middle. So put your level there, put your trades there. So that's the Singularity. It is a beautiful model. It has started to take me on the path to getting out of drawdown. And that's the reason that I like it so much. It is reliable. When I first got into live trading, I was really excited. I was doing really well. I was trading ES. I was risking 25% of my account sometimes and did really good. And then I got too close to the sun and my wings melted and I took some drawdown. Those are some heavy positions, way too heavy for the capital that I have. So I took some drawdown, and I've been in drawdown for about a month, but I've been using this model to chip away at it and bring myself back out of drawdown. It's that reliable. So there you have it, guys. If you have any questions, let me know. Otherwise, give it a shot. See what you think. There are a lot more details that I have that go along with this model that I keep to myself. I hate to say it, and now you're going to be chomping at the bit for it, but it's true. This is meant to be very simple, meant to be very mechanical, but there are different things that I do to help manage this and pick the right setups or get out of it if I need to, and that kind of thing. So go learn it, go figure it out, go see what works best for you. Learn the intricacies that do come along with this model. There are so many awesome details where you're just like, damn, this thing works good. So that's all I have for you today. Enjoy and let me know how it goes for you. Thanks.